Hello and welcome to this Business Today Market Special. I'm Udayan Mukherjee and with me is our special market guest for today, Sridhar Sivaram, a veteran investor over many decades and investment director of Enam Holdings. Sridhar, it's great to have you on the show today. Let me ask you about the market first because the indices have been quite resilient. They've not corrected more than 10-12%. But underneath, the mid cap and small cap damage has been far more extensive, 25-30% in many cases. How would you classify this market? Would you call it a stealth bear market even, or is it a market which is just consolidating the gains made since the start of the 2020 rally?
Yeah, so I wouldn't yet call this a bear market, but there is a steady correction in progress, which is in line with what is happening with other global markets. Uh, I think some of the large caps have held very well, and we are seeing some sort of a rotation. So if you see, there have been correction even in the large cap space, and there have been other stocks which have been underperforming in the past, which have been holding up well, which is why we see the Nifty or the Sensex still, plus minus 3-4% over the last 3-4 months. So I would categorize that this is a sort of consolidation that we are seeing right now. But our own view is that 22 is a challenging year because of the multiple headwinds that we are seeing right now and what we are going to see ahead. It's a market which one has to tread very carefully for the current year.
So these multiple headwinds that you're talking about, Sridhar, do you think they can lead to more absolute downside to this market? Or do you think we will get away with this kind of sector rotation and holding in a broad kind of a range till the year is out? I mean, are you expecting even deeper volatility?
I think volatility is surely going to be deep. Question is whether we see a deeper correction in the absolute index. I mean, that's very difficult to predict. But what we are seeing is that wherever we are seeing high growth, high multiples, and even the slightest amount of disappointment, those stocks are getting corrected very sharply. I would say there is a shift between value and growth. So we are seeing value emerging after many years in India, where value stocks are coming into the front, and growth stocks are being questioned, especially the hefty growth stocks with hefty multiples, growth at any price. Those sort of stocks, the market is now questioning the wisdom of some of the pricing there. So I think that's what we are seeing right now. If suppose there is a large global correction because of Fed tightening or something else, will our markets correct a bit more sharply? It's possible. I think it's very difficult to predict those events. But as I mentioned earlier, that our own view is that protect capital is the mantra for 2022, and we would look at opportunities to buy into stocks only if we find the price really compelling.
So let me ask you about this growth at any price kind of stocks, Sridhar, because they did quite well through the difficult periods a few years ago. But this year, notably, they're underperforming. In the past, we've seen many of these expensive stocks go through very long periods where they did not return anything. I mean, the Hindustan Levers of the world, I mean, went through
Yes.
7-8 years, even 10 years of
Yeah.
practically no returns. Do you see that kind of situation happening to the Asian Paints or the Bajaj Finances of the world, which may have some growth, but P multiples are in absolute terms very expensive? Can they underperform for very long periods of time?
Yeah, so I'll not get into the specifics and specific stocks, but in general, markets are slaves of earnings. So as long as companies can deliver strong earnings, and if they are, say, trading at very high multiples, then I would say they need to deliver north of 20% earnings to sustain the high multiples. If they are not able to, then the market's wisdom to give such high multiple to some of these companies will come under question. I think which is what we are seeing right now, that some of these companies are continuing to deliver on high growth, so they continue to stay in that elevated multiples. I don't know for how long, but for now they continue to stay. Where we are seeing disappointments, as you mentioned in the past, that this has been a cycle where we've seen in the past also that large staple companies have underperformed for 10 years. We've seen that with even financials. Many of them have underperformed for a period. We are seeing even right now when some of the financials are underperforming. Staples in the last 3-4 years have actually underperformed, and they are again very high P multiple companies. Some of the new age companies which have got listed had a lot of fanfare as they got listed, but now we are seeing, sanity come back. Only time will tell whether these prices are right or they need to correct more. So I think it's a phase where market is realizing that there are headwinds and we need earnings support for stocks to stay on. And we are seeing churning in the portfolio. And I think this is a healthy signs that from a market standpoint that some of these corrections are happening, allows people to reflect on the portfolio that they're currently holding.
You mentioned this dichotomy or divergence between growth and value, but what to you constitutes value in this market, Sridhar? And where do you see the possibility of even some amount of P multiple expansion, a possibility of that? Because on one hand, P multiples are correcting because of interest rate concerns, etc. But on the other hand, do you see some of these stocks which have been ignored in previous years actually seeing or responding at least to their earnings growth, possibly even to some amount of PE expansion possibility?
Yeah, I think the very obvious name that comes to my mind is the PSU basket. I mean, they are deep value. And in the past, actually, I've been a growth investor for almost 20 years. And maybe once in a while in my previous avatar, we would have bought into some of the large banks. But outside that, very few PSUs we would have bought. But sometime end of 2020, I think the entire PSU basket was trading at some market cap of, I think, 7 or 8 lakh crores. Reliance single stock was trading at almost double that, value. And I'm talking of all the PSUs put together, excluding the financials. I mean, it was so absurdly priced. I mean, we just couldn't, this is some analysis we did and we actually double checked. So, I mean, that's what I'm saying was value. And today that number is somewhere in the 16 lakh crore. I mean, the same like to like number is 16 lakh. So that's the jump that you've seen in PSUs as a basket in terms of market cap. And still, I would say many of them are trading at 4%, 5%, 6% dividend yield. So there is a lot of value still lying there. Of course, there are challenges in that segment, which is that these are government owned. They are never going to get the same multiple as a private sector. But there are times when you feel that, this has gone to an extreme extent. I'll give you one more example that sometime in November of 21, November 20 actually, got into a call with a PSU bank who was trying to raise funds to shore up their capital. And honestly, got into the call thinking I'll just get some update on what's happening in the financial segment. And that's about it. I'm really not going to invest. As I came out, I realized that the market cap of that bank was lesser than the pre-provision profit. It was so absurd. Obviously, that stock has doubled, more than doubled from there. But I'm just saying that some of these absurdities you find in the market, are they structural stories? I would say no. These are cyclical lows where you get some of these stocks, you play the cycle, and then you move on. That's how I would put it. So PSUs is one, commodities were the other. They were deep. I mean, typically you buy commodities at 0.3, 0.4, 0.5 book. And sometime end of 2020 or even middle of 2020, you were seeing that. Now, of course, the story for commodity has changed because you're almost entering into a super cycle. So I think there are baskets or there are segments in the market where you do find value, extreme value, deep value. And it is a lot of patience to hold some of these stocks because there's no instant gratification in some of these. You hold on, stocks may not do anything for 6 months, 8 months, 12 months, but when they give returns, they give you outsized returns. That's how I'll put it.
Sure. Speaking of PSUs, the mother of them will be listed soon. The IPO is coming. What does it do to dynamics in the insurance space, the LIC IPO, Sridhar? Do you think it has a bearing on how private sector insurance companies like HDFC Life, ICICI Prudential would be valued? I mean, how do you see the interplay between the listed insurance companies, which are growing faster, but as stocks have not performed over the last 1 year at all?
So I've had a very contrarian view on insurance for a while now. In fact, I've been, consistently highlighting that India is an over-penetrated insurance market, contrary to all the numbers that you see in the DRHP and all the other slides that other private sector banks highlight. I mean, just to give a rough number, India has 300 million outstanding life insurance policies. And if you assume that India has roughly, say, around 300 households and only half of them are insurable, you already are talking of two life insurance product per household. And then you come to, the penetration, that penetration of India life insurance is about 3% of GDP. China and Brazil are 2.5%. And keep in mind that financial products penetration has to be compared based on the per capita. India's 2,500 per capita. China's close to 8, 9,000 or 10,000 now. So whichever way you cut it, India's insurance is heavily overpenetrated, and we hardly sell protection. So what insurance we say is insurance companies continue to sell protection because they have a tax arbitrage. Keep in mind that all the products that insurance companies sell, it's tax free in the hands of investors. So you really don't sell protection because these companies are selling some sort of a savings product. So if you ask me broadly, the government has already plugged the loophole as far as ULIP is concerned in terms of now it is taxable in the hands of investor. I think post LIC, I won't be surprised if the government plugs this loophole also. So I think the insurance companies, if they were selling protection, I would have been very happy. I would have been a buyer of these stocks. They continue to sell savings products, which really is a tax arbitrage that they're doing. So as I said, I have a very contrarian view on the life insurance sector. Having said that, LIC is the largest player out there, and they sell to a different set of people altogether. I mean, I don't think the private sector interface with the LIC is that high, because the private sector typically sells to the HNIs and slightly the middle income group, and LIC is more at the bottom of the pyramid. So yeah, some of little bit of the dynamics will change once large company gets listed. You get more data to compare. Corporate governance of the public sector expected to improve, but broadly, that's my view. Given where the valuation of private sector insurance companies is, it just doesn't add up.
Okay. You mentioned commodities as well, Sridhar. And I took your point that maybe a year and a half back, it would have been a good time to get into commodity stocks. Now, what would you do for somebody who's examining both ferrous and non-ferrous metal stocks? Have they missed the boat if they are not already in it? Is it time to become cautious on commodities given what's happening across the world?
So we are actually still very bullish on commodities, and I'll give you a very simple reason for being bullish. We haven't seen any investments, large scale investments in commodities in the last 4 5 years, thanks to the ESG concerns. I mean, I'll give you an example. About 6 8 months back, we were on a call with a large Indonesian coal company. And it's a listed company. And they were mentioning that thanks to ESG, forget equity, they're not even getting debt funding for a new coal mine. I mean, that's the extent of this whole ESG concern that has come up. What is happening because of this is that this transition is going to be very painful between the fossil fuel versus the new energy, or even for that matter, metals. I mean, you mentioned ferrous and non-ferrous. We are very bullish on the non-ferrous because even if you think of EVs or some of the newer energy, the demand for copper, demand for silver, zinc is still going to be there. And unfortunately, we've seen very poor investments by companies in this segment. The other good point as far as commodities concerned is in the previous cycle, and I've seen two bull cycles of commodities in the last 25 years, as soon as you saw high prices, companies would come and announce massive capex because that's been the norm historically. What we are seeing is a very different trajectory this time. Companies are actually distributing the cash back to shareholders. So for a change, the minority shareholders are actually enjoying the benefits of high commodity price by getting some cash back. Barring a few companies here and there, most companies have just announced, maintenance capex or just some very marginal capex. As a result, the cash in the hands of investors is substantially going up. So I would say that we are going to see a cycle higher for longer, and it'll surprise a lot of bears on the commodity side. That's my view. I mean, time will tell if I'm right or wrong.
You spoke about under-owned sectors and sectors where valuations had become very compelling. In the PSUs you used as an illustration. Do you think the same logic could extend to something like an autos, which are quite under-owned and seem like a very unloved sector in terms of weightage in their index as well? Or do you think the dynamics of what's happening in the EV space actually does not make the case for autos very compelling despite low valuations?
So I think the auto, especially the two-wheelers, are in transition. Whether we like it or not, EV is here to stay. Yes, they are having some, starting issues. We're seeing news about, flaring up of batteries and stuff like that. But if you just, move around in Bandra or in Mumbai, what you see is off late we are seeing these new sort of electric, I won't even call them bikes, they are in between a moped and a cycle, which is all over the place and they don't even need registration. So all the delivery boys are using something called a yulu bike or something equivalent of that, and no registration required, and they're moving around. I'm just thinking that if this was not there, possibly they would have been using a bike or a scooter or something, some other two wheeler to deliver. So I think this segment is seeing some sort of a transition where many people who want to buy a new scooter or a bike are waiting to see if the electric option is a better option. So given this transition, one, what we are seeing is the demand for the products are low right now, and two, the valuations are correcting because the segment itself is in a transition. So we've in the heydays we used to give 20 times or 25 times multiple to some of these companies. They're now coming in their low teens, and I don't see that changing. So maybe if it continues here and we see a cycle of growth, maybe they will, move along with their earnings. I don't see a strong re-rating for these companies, at least in the near future, till the dust settles on EV and we get some sort of clear understanding of how the space is going to move. Maybe in the passenger vehicle, it will take much longer. So maybe there's a case there, or there's a case for the commercial vehicles, or the tractors is slightly a different story, which has to be looked at from a rural angle. But maybe there's a case in those. Two-wheeler, I think, is a space one can avoid in my.
Okay. We started this chat talking about the multiple headwinds through 2022. To your mind, Sridhar, what is the bigger headwind? Is it the inflation concerns in both India and the Western world and what the central banks need to do and what that means for equities? Or do you think would you place geopolitics even higher than the inflation concerns? What's the main risk, central risk?
I think the central risk is inflation. The geopolitics is a noise in between, and sometime or the other, this will settle down and we'll move on. But the inflation concern is not going. And actually, my worry is more the global inflation than the India inflation, because in India, we follow CPI. And keep in mind that food is more than 50% in CPI. We are seeing some spurt of food inflation currently because of many geopolitical issues, because palm oil and many of the other oil-related stuff India has to import. But generally, India's surplus food, be it wheat, rice, sugar, vegetables, we are generally we have surplus of these food. The food inflation typically flares up in the summer months, which is where we are right now, which is April, May, and then sharply corrects as rain comes in. So given the high weightage of food as far as the CPI basket is concerned, and a very low weightage for oil and power, I think it's just around 10% weight for oil and power. I'm not so worried about India's inflation. I think it will cool down as the rains come. But globally, there is an issue because India has a tolerance closer to 4%. US inflation is 8% and their tolerance is 2%. So I think we have a problem as far as inflation in the US is concerned. And they have a lot more dependence with global trade as far as inflation is concerned. So I think it's well documented that Fed is behind the curve. We'll continue to see rate hikes coming from the US, and that has an impact on emerging markets. And unfortunately, we are part of the emerging market basket. which currently already is suffering dramatically thanks to what is happening in China. In fact, I was recently looking at the number that emerging markets as an asset class for the last 15 years hasn't given any returns. It is still 25% lower than the 2007 peak. I mean, that's as dramatic as it can get. Within that, India has done well, but the fact that we are seeing huge FIS selling in India is also a collateral damage that India is facing because there is an outflow from the emerging markets, especially the Asian basket. So I think I'm worried more about inflation, which is the global inflation. Yes, India is having inflation right now. We will see rate hikes coming soon, but I'm not so worried about India's inflation. I think it'll settle down in the next 6 months.
Sridhar, always a pleasure hearing your thoughts. Thank you very much for taking time out
Thanks a lot,
today.
Udayan. Thanks a lot.
If you like the video, do like, comment, share and subscribe.